Have you ever wondered how economic power really moves beneath the surface long before trillion-dollar funds and global financial giants existed? What if the true architects of economic revolutions were not governments, not empires, not banks, but a small group of families whose names most people have never even heard? Families who manipulated currencies, redirected trade routes, financed wars, ignited crises, and shaped entire nations without ever stepping onto a battlefield. When you look deeper into global history, a disturbing pattern emerges. Political revolutions may take the spotlight, but economic revolutions, the ones that quietly rewrite the rules of power, almost always begin with private dynasties operating in the shadows. Before modern institutions, before Wall Street, before central banks gained authority, these families were already engineering systems that determined who rose, who fell, and who paid the price. Their influence was not loud. It was systematic, deliberate, and astonishingly precise. They financed empires when states ran out of money. They stabilized collapsing economies when governments were desperate, and they profited from every crisis they helped create. The world remembers kings, emperors, and presidents. But behind nearly every major economic turning point, there were private financiers pulling invisible strings. What makes this even more unsettling is that these early financial dynasties operated without oversight, without regulation, and without public accountability. They were global long before globalization existed. They understood leverage centuries before modern economics named it. They weaponized debt before debt became the cornerstone of the modern financial system. And the most fascinating part is this: the blueprint they created still defines how economic power works today, not just in markets, but in governments, currencies, and geopolitical decisions that reshape the world. As we begin the story, the real question is not whether these families had influence. It is whether the systems they built ever stopped shaping the world at all. And if they did not, then understanding their actions is not just historical curiosity. It is essential for decoding the crises, manipulations, and power plays unfolding right now in our century under the illusion of transparency and stability. What you're about to see may challenge what you thought you knew about how global power truly operates and why certain patterns keep repeating no matter how much the world changes. Before we move forward, tell me in the comments whether you have ever suspected that private financial power has influenced major historical events. Your insight matters because understanding this content shapes how we see modern crises. And make sure to like this video and check if you are already subscribed, so you do not miss the next layers of this story as we unfold them naturally into what comes next. To understand how these early financial dynasties gained such extraordinary influence, you have to look at the moment when global trade was still chaotic, unstable, and dominated by empires that believed military strength alone secured power. It was in this environment that a few families realized something revolutionary. Controlling money, credit, and commerce was far more effective than controlling territory. While kings were obsessed with land, they were studying flows of silver, exchange rates, shipping, routes, and the weaknesses of governments that spent more than they could ever repay. They saw opportunity where others saw crisis, and that vision allowed them to build financial empires that quietly surpassed the political empires they served. What made these families different was not simply wealth. Countless merchants were wealthy. It was their ability to identify patterns others were blind to. They saw that nations fought wars long before they were financially prepared. They saw that empires expanded even when their treasuries were already bleeding. They saw that every government sooner or later reached for loans to cover deficits, military campaigns, infrastructure, and political ambitions. And because these families understood that lending to a state was not about interest, but about access, they positioned themselves as indispensable long before the state realized it had become dependent. Their rise did not happen in a single leap. It was a series of calculated moves. Across decades, they embedded themselves in trading hubs where currencies fluctuated daily, where information traveled faster among merchants than diplomats. They built networks that spanned continents, creating alliances through marriage, religious ties, and strategic partnerships. They became trusted intermediaries, the ones who could move capital safely when kingdoms were collapsing, the ones who understood risk so deeply that governments treated them as advisors rather than mere lenders. And because these families were not constrained by borders, they were early masters of something modern institutions call asymmetry of information. They knew which regions were failing economically before the rulers did. They learned which currencies were weakening while officials still insisted everything was stable. They sensed when a market would collapse because they were the first to see ships arriving half empty, the first to observe merchants changing their preferred means of payment, the first to detect when confidence silently evaporated. This early mastery of global patterns allowed them to rise above traditional merchants who operated only locally. They were not just traders. They were analysts, strategists, brokers of influence. They built the foundations of international finance long before the concept officially existed. And as their networks expanded, states gradually realized that these families could do something governments could not do alone: stabilize an economy, in panic, redirect capital with precision, and anticipate crises before they exploded into political disasters. Their emergence was not accidental. It was the beginning of a parallel system of power, one that operated quietly while kingdoms and empires loudly claimed authority. And the deeper you look, the more obvious it becomes that the seeds of today's global financial landscape were planted by these early dynasties who learned to bend economic reality long before trillion-dollar. Institutions inherited their methods. As these families expanded their reach, they began to construct something far more sophisticated than trade networks. They were building the early architecture of financial power, a system designed to operate independently of governments while appearing to serve them. Their real strength came from understanding that money is not merely a medium of exchange, but a lever that shifts political decisions, public sentiment, and even the survival of entire regimes. Rather than accumulating wealth in static form, they learned to convert it into influence, shaping outcomes that aligned with their long-term interests. The key was control of liquidity at moments when states were most vulnerable. When a government faced a war, a succession crisis, or an internal revolt, these families became the silent arbiters of possibility. A kingdom could only deploy armies if someone financed their supply lines. A monarch could only maintain legitimacy if salaries were paid on time. A collapsing economy could only be stabilized if credit flowed before panic consumed the population. These families watched rulers negotiate from desperation, making concessions that seemed minor in the moment but shifted the balance of power indefinitely. They also mastered the subtle manipulation of currency systems long before central banks existed. In an era when coins were often debased and metal content fluctuated, they tracked purity, weight, and scarcity with scientific precision. They understood that the value of a coin was not what the government stamped on its surface, but what the market believed it represented. When governments issued inflated currency, they adjusted their dealings instantly, preserving their strength while states unintentionally weakened themselves. This ability to anticipate monetary distortions made them indispensable partners, but also dangerous ones, because they could withdraw confidence faster than a kingdom could replace it. One of their most powerful strategies was the creation of interlinked credit chains. By lending simultaneously to merchants, shipping companies, and state treasuries, they ensured that entire economic ecosystems depended on their approval. A government that ignored their advice risked being cut off from capital. A merchant who betrayed them risked losing access to trade routes. This web of dependency functioned like an invisible empire, stretching across borders without raising a single flag. Their influence deepened as they became repositories of information unavailable to rulers. They knew the financial health of multiple nations at once because they were inside each one's balance sheet. They could see when one kingdom overspent on armies, when another ran into agricultural shortages, when a third suffered from internal corruption. They were not guessing. They were reading financial reality in real time. With this knowledge, they positioned themselves ahead of every shift, adjusting their strategy while entire governments reacted too slowly to avoid collapse. Over time, kings and ministers began to consult them not only for loans but for guidance. Their expertise became a form of political leverage, and their discretion made them even more valuable. They seldom took public credit, seldom appeared in official records, yet their fingerprints were present in every major economic transformation of their era. They were no longer just financiers. They were architects of outcomes, shaping the trajectory of nations through systems they understood better than the rulers who relied on them. Their growing sophistication marked the transition from simple financial opportunism to the deliberate engineering of influence, setting the stage for the first truly global economic revolutions, driven not by states, but by private power operating behind the illusion of national authority. As their systems matured, these families began orchestrating something far more transformative than financial influence. They were triggering the first large-scale economic revolutions disguised as ordinary market developments. These shifts did not appear dramatic in the moment. A change in lending terms here, a new credit route there, a quiet restructuring of how trade was financed. But collectively, these decisions rewired entire economic landscapes, redirecting the flow of wealth in ways that governments could neither anticipate nor control. What made these changes so powerful was that they unfolded beneath political awareness, driven not by ideology or national interest, but by the calculated logic of private gain. Governments often believed they were initiating reforms or responding to crises, unaware that these families had subtly guided them into positions where the outcome was already predetermined. When a state adopted new taxation strategies, expanded its navy, or opened new trade routes, it was frequently reacting to financial pressures the families had engineered. They understood leverage not only in monetary terms, but in psychological terms. A ruler who believed he was choosing freely was far easier to manage than one who recognized he was being influenced. By controlling the conditions surrounding political decisions, these families shaped the decisions themselves. Their revolutionizing impact became most visible during periods of instability. Economic instability was not an obstacle for them, it was an asset. When markets panicked, they were the buyers. And when states defaulted, they were the rescuers. When trade routes collapsed, they were the ones who reopened them under new terms that favored their interests. Patterns that looked like coincidences were, in fact, the result of long-term strategy. They had mastered the art of positioning themselves so that every downturn created new opportunities, and every upturn reinforced their existing influence. What amplified their power even further was their ability to move capital across borders faster than governments could respond. While monarchs debated policy or waited for couriers to deliver news, these families already knew which economies were tightening, which currencies were weakening, and which regions were ripe for expansion. With this speed, they could redirect wealth in advance of major geopolitical events, profit from transitions that appeared sudden, and leave states struggling to make sense of shifts that felt unpredictable but were anything but. Their role in reshaping the global economy was not simply a byproduct of success. It was an intentional strategy, rooted in a deep understanding of how fragile political structures really were. They exploited the gap between what governments assumed they controlled and what they actually controlled. And by operating in that gap, they triggered transformations that historians would later describe as natural economic evolution, when in reality those shifts were designed long before they became visible. Before we continue, tell me in the comments which part of this hidden economic transformation surprises you the most, and why you think these early financial revolutions remained invisible to the public for so long. As these financial dynasties expanded their influence, the ripple effects of their decisions began shaping events far beyond markets and trade routes. What appeared to be isolated political tensions, sudden military campaigns, or unexpected economic collapses were often the downstream consequences of financial shifts initiated long before any ruler realized the ground was moving beneath them. These families had learned something that states would take centuries to understand. Economic pressure could be more decisive than any army, and credit could determine the outcome of conflicts long before the first shot was fired. When empires prepared for war, they rarely recognized how dependent they had become on private financiers for the resources required to sustain their ambitions. Armies were funded with borrowed capital, fleets were built on borrowed credit, and territorial expansion relied on financial stability that was often fragile and misunderstood. Meanwhile, these families evaluated each conflict with clinical precision, identifying which side offered the most strategic advantage, the highest return, or the best long-term positioning. They did not rely on ideology or loyalty, they relied on arithmetic and opportunity. This selective financing created an effect that few political leaders anticipated. By choosing when to extend credit, when to restrict it, and when to shift funds between competing powers, they effectively determined which empires rose and which collapsed. A state with ample loans could expand aggressively, while a rival starved of capital could not mobilize its forces or stabilize its currency. Even the perception of financial weakness could fracture alliances, weaken supply chains, or trigger civil unrest. Economic momentum, once influenced, could accelerate the downfall of an empire faster than any battlefield defeat. Crises became moments of strategic realignment rather than accidents of history. A sudden shortage of silver in one region, a collapse in commodity prices in another, or an unexpected tightening of credit in a major port city could send shockwaves through political systems already stretched thin. Governments responded by implementing emergency policies, raising taxes, or issuing decrees that seemed desperate because they were. Yet the families who had anticipated these shocks were already positioned to capitalize on them. Their understanding of interconnected financial systems allowed them to shape outcomes, while rulers struggled to understand the causes. This pattern created a recurring dynamic. As states leaned more heavily on private financiers, the financiers gained insights into the vulnerabilities of those states. They could see when a treasurer concealed deficits, when an empire overextended itself, when internal factions destabilized governance. They held the kind of information that kings desperately needed but often received too late. And because information was power, they wielded it quietly, ensuring their structure of influence remained intact across successive crises. Over time, the effect became unavoidable. Private financial interests were directing the tempo of global change. Wars, reforms, revolutions, and economic transitions were all influenced by the flow of capital controlled outside governmental authority. The world believed political power was the engine of history, but the families operating behind the scenes understood that financial power was the true mechanism that determined which historical paths became possible and which were quietly closed long before anyone noticed. As the 19th century dissolved into the 20th, the landscape these families had shaped began transforming into something even more complex. Industrialization accelerated trade, expanded communication networks, and created financial demands that no single dynasty could manage alone. Yet, rather than being replaced, these families adapted by merging their methods with emerging institutions. Their influence did not disappear, it evolved, spreading into the foundations of the modern financial system. What had once been private networks and discrete alliances now began integrating into formal structures that resembled the centralized financial architecture we recognize today. This transition was not accidental. Governments, overwhelmed by economic volatility, global competition, and rapid technological change, sought stability. But stability required specialized knowledge, and the only entities with centuries of accumulated expertise were the same families that had long whispered through the corridors of power. Their role gradually shifted from being external financiers to becoming architects of institutional frameworks. They advised on the creation of national banks, influenced monetary policy, and helped design systems intended to bring order to increasingly chaotic markets. Yet beneath this veneer of structure, the same logic of leverage and influence endured. Central banks, bond markets, and regulatory bodies emerged during this period, but these institutions were often born from collaboration between states and the very financial dynasties that once operated independently. The boundaries between public, authority, and private influence blurred. Those who drafted early banking legislation were frequently the same financiers who stood to benefit from the new rules. Monetary policies that seemed to stabilize economies often reinforced the underlying dependency of governments on private capital. Each crisis reinforced this relationship, and each solution deepened it. Information became the new form of power, and the families who had once relied on letters, couriers, and intuition were now using telegraphs, international cables, and data networks to maintain their advantage. The speed of information transformed finance itself. Movements of capital that once took weeks now occurred in hours. Market reactions became immediate, and with them came new opportunities for those who could interpret the world faster than governments could react. These families were prepared for this shift because they had always understood the value of information, long before nations treated it as a strategic asset. As global conflicts erupted, the role of financial power became even clearer. Wars demanded capital at unprecedented scales, and states turned to financiers not only for loans, but for strategic guidance. Private financial expertise influenced national decisions on wartime spending, currency stabilization, and resource allocation. And when the wars ended, the reconstruction phases created opportunities for consolidating financial dominance further. Institutions that emerged from these periods, whether international banks, cooperative monetary systems, or cross-border agreements, carried the imprint of the same logic the families had refined over centuries. By the early 20th century, what had begun as a small network of powerful families had transformed into the blueprint for global finance. The methods they pioneered, manipulating credit, leveraging crises, shaping policy from the shadows, became embedded in the new institutions designed to manage modern economies. States believed they were building structures of independence and resilience, yet much of what they created reflected lessons learned from private powers that had mastered these strategies long before bureaucratic systems existed. The world had entered a new era, but the DNA of that era traced back directly to the quiet financial architects who understood that shaping money was shaping history itself. As the 20th century progressed, the influence of these financial dynasties became increasingly subtle, yet more pervasive than ever. They no longer needed to operate as visible lenders or distant merchants. Their strategies had evolved into mechanisms embedded deep within the global financial system. Mechanisms that shaped markets, governments, and public sentiment without revealing the hands behind them. What appeared to be neutral economic forces were, in reality, the perfected techniques of private power refined over generations. Currency valuations, debt cycles, investment flows, geopolitical tensions. These were no longer random shifts, but predictable outcomes of financial architecture, designed to reward those who understood its hidden structure. The real transformation occurred when financial influence detached from physical assets entirely. Money no longer required ships, warehouses, or trade routes. It required information, prediction, and speed. Modern institutions believed they were ushering in an era of economic transparency, but in truth, they were creating the perfect environment for invisible control. Markets became global, but so did the asymmetry of knowledge. Those with access to early data, private negotiations, or internal political signals held an advantage so vast that governments often reacted to crises that financiers had already positioned themselves to exploit. During periods of apparent prosperity, these families quietly strengthened their networks, embedding trusted figures inside regulatory bodies, advisory committees, and financial institutions. They influenced the frameworks that defined monetary policy, shaped how nations measured economic stability, and even guided the creation of international systems meant to prevent financial collapse. Yet these systems often protected the interests of those who helped design them. The line between guarding the global economy and guarding their own influence became indistinguishable. Crises only amplified their strength. Market crashes, currency failures, and geopolitical disruptions were not endpoints. They were opportunities. When panic spread, they were prepared. When institutions faltered, they stepped in. When governments struggled to respond, they provided solutions embedded with long-term leverage. Entire nations became dependent on systems originally crafted to consolidate private power, unaware that every emergency deepened the structural advantages of those who understood how to navigate and manipulate volatility. This era of invisible manipulation created a paradox. States possessed more formal authority than ever, yet less real control. Financial flows could override political decisions. Markets could punish national policies within hours. Private capital could destabilize or support entire regions based on strategic intent rather than democratic processes. And through it all, the families and institutions that carried forward these centuries-old methods continued to operate from the shadows, shaping global outcomes under the guise of economic inevitability. Before we continue, tell me in the comments whether you believe this shift toward invisible economic influence has made the world more stable or more vulnerable, and why you think these patterns are so difficult for the public to recognize. As the 20th century gave way to the 21st, the influence once concentrated in a handful of financial dynasties began migrating into newly emerging entities that possessed scale, speed, and global reach far beyond anything their predecessors could have imagined. These were the giants of modern finance: asset managers, sovereign funds, multinational banking conglomerates, and investment institutions controlling sums so large that entire national budgets seemed small by comparison. Yet, despite their imposing size, these institutions did not represent a break from the past. They were the natural evolution of a system carefully shaped over centuries, inheriting the same logic, strategies, and structural advantages. Pioneered by the earliest families who understood that economic control was far more enduring than political authority. What distinguished these modern giants was not merely the amount of capital they controlled, but the breadth of influence they exerted across every sector of the global economy. While earlier families operated through discrete networks and targeted leverage, the new financial titans commanded influence through diversified ownership and automated flows of capital that touched nearly every major corporation on Earth. They no longer needed to intervene directly in political decisions. Their power was embedded in the structure of global markets. If they shifted a fraction of their assets, entire industries felt the impact. If they rebalanced portfolios, currencies moved. If they reassessed risk, governments scrambled to adjust policies. The sheer scale of these institutions allowed them to shape economic outcomes invisibly. Pension funds, index funds, sovereign wealth funds, and global asset managers accumulated ownership stakes across thousands of companies, often without public awareness of how concentrated this ownership had become. The influence once carried out through secret letters and private meetings was now executed through financial algorithms, allocation models, and silent voting power in boardrooms scattered across continents. Decisions that shaped the future of energy, technology, infrastructure, and national development were no longer tied to elections or public debate. They were tied to capital flows controlled by a few global entities. Yet the most remarkable element of this new era was how familiar the underlying logic seemed. The strategies dominating modern finance, leveraging debt, exploiting asymmetry of information, using crises to consolidate influence, were not innovations of the digital age. They were simply modernized forms of techniques refined long before. Derivatives, bond markets, structured assets, and liquidity. Mechanisms mirrored the principles the early dynasties mastered when currency still relied on silver and trade routes depended on wind. The tools changed, but the objective remained the same: influence without visibility, control without direct authority, power without political accountability. These financial giants also inherited the role of stabilizers the earlier families had played. During economic turmoil, they stepped in to absorb risk, acquire distressed assets, or support markets on the brink of collapse. Governments increasingly relied on them not just for capital, but for legitimacy. When a fund endorsed a policy or signaled confidence in a nation's economic direction, markets followed. When they withdrew support, consequences were immediate and severe. States that once believed sovereignty depended on military or political strength now found themselves subject to the quiet approval of entities operating outside electoral systems and beyond national borders. In this transformed landscape, the scale of power no longer depended on family lineage, but on structural control. Modern financial giants had become the continuation of a centuries-old story. inheriting the blueprint crafted by those who first recognized that shaping economic systems was the most effective path to shaping the world itself. As these modern financial giants expanded their reach, the long arc of economic history revealed a pattern that was far too consistent to ignore. What appeared to be cycles of progress and decline, crises and recoveries, booms and collapses, were not random fluctuations of the market, but recurring outcomes shaped by the very structures built centuries earlier. The methods used by early financial dynasties had not vanished. They had simply been absorbed into the global system. And because the logic underpinning that system remained unchanged, the world continued to experience the same sequence of events, only on a scale far larger, faster, and more interconnected than ever before. One of the most striking continuities was the predictable rhythm of debt expansion followed by systemic correction. Governments, corporations, and individuals were encouraged to borrow during periods of optimism, pushing growth to artificial heights. Yet the moment confidence weakened, liquidity tightened, and the entire structure exposed its fragility. The collapse of one sector could cascade across continents, revealing how deeply intertwined modern economies had become. These shocks were often presented as unforeseen failures or unfortunate consequences of market psychology, but they echoed patterns recorded centuries earlier, when private financiers manipulated credit to reshape political and economic landscapes. Another familiar phenomenon was the concentration of influence during crises. History repeatedly showed that those who controlled capital during moments of distress gained disproportionate power in the aftermath. When modern markets faltered, when currencies destabilized, or when political uncertainty disrupted investor confidence, it was the largest financial institutions that determined which entities survived and which vanished. Through acquisitions, restructuring agreements, or coordinated interventions, they steered the direction of entire industries without ever appearing on the public stage. The same dynamic that once allowed families to dictate the fate of empires now operated through sophisticated mechanisms hidden inside global financial frameworks. The recurrence of these patterns revealed something deeper about the nature of economic control. It was not merely about wealth or access. It was about the ability to anticipate structural vulnerabilities long before they manifested publicly. Early financial dynasties mastered this by studying trade flows, currency shifts, and demographic pressures. Modern institutions perform similar analyses at incomprehensible scale, using algorithms, data, networks, and predictive models to read the global economy like a living organism. In both eras, the advantage lay not in reacting to events, but in shaping the conditions that made certain events inevitable. Yet the most revealing pattern of all was how public narratives consistently obscured the mechanisms of power. Crises were attributed to speculation, policy errors, or geopolitical tensions, while the deeper structural causes remained hidden beneath layers of technical language and institutional opacity. This separation between public perception and financial reality ensured that the same cycle could repeat without meaningful scrutiny. People saw the symptoms, recessions, inflation, market volatility, but not the architecture that produced them. And because the architecture persisted, the cycle endured. What emerged was a global system that behaved exactly like the earlier eras shaped by private financiers. Crises redistributed power upward, booms amplified structural advantages, and governments increasingly operated within a framework they did not fully control. The world had changed in its technologies, its scale, and its complexity, but the underlying rhythm, the quiet convergence of influence, information, and economic leverage, remained unmistakably the same, guiding nations and markets along paths carved long before they realized they were following them. As the 21st century unfolds, the legacy of these financial architects continues to shape the trajectory of global power in ways most people never see. Modern institutions may appear more transparent, more regulated, or more accountable than the private dynasties that once influenced empires from behind closed doors, yet the fundamental dynamics remain unchanged. A small number of entities still guide the flow of capital across continents, still influence the stability of currencies, and still determine which industries rise or collapse. What has evolved is the scale, the speed, and the subtlety with which this influence operates. The machinery of global finance has expanded into a network so vast and interconnected that even governments find themselves navigating a system they do not fully command. Today's economic landscape is shaped not just by policies or political ideologies, but by the structural forces embedded deep within financial architecture. Asset managers capable of moving billions within minutes can shift economic momentum more decisively than legislative bodies. Debt instruments, derivative markets, and cross-border investment flows act as levers of influence that outpace traditional geopolitics. And through this complex environment, the original blueprint crafted by the earliest financial dynasties continues to echo. They demonstrated that control over money is control over possibility, and that shaping economic frameworks is often more impactful than any position of political authority. This continuity becomes especially clear when examining how nations respond to modern challenges. Whether confronting inflation, currency instability, supply chain disruptions, or capital flight, states rarely act independently. They coordinate with central banks, align with major financial institutions, and adapt their decisions to the expectations of global markets. In moments of uncertainty, governments turn not inward toward traditional sovereignty, but outward toward the very system built on centuries of private financial logic. The influence is not loud, it is embedded. It does not announce itself. It simply directs outcomes through the structures it controls. Yet the most revealing insight is that the public often interprets these shifts as accidents, as temporary turbulence, or as the result of political incompetence. Few recognize how much of the world's economic direction is predetermined by the incentives built into financial systems long before a crisis emerges. The people who first engineered these systems understood that true power lies not in reacting to events, but in designing the environment in which those events occur. And that principle has survived every era of reform, every technological leap, and every political cycle. Understanding this continuity is not about predicting collapse or assuming conspiracy. It is about recognizing that power does not disappear. It adapts. The forces shaping the next economic revolution will not arise suddenly. They are already operating, quietly extending the same logic the original families perfected centuries ago, and seeing that pattern clearly is the first step to understanding where the global economy might move next. If you reach this point, leave a comment saying, "I see the pattern, so I know you stayed with the story until the end." And if the value in this narrative opened your perspective, consider subscribing to follow the next chapters of how economic power truly evolves. A like helps this message reach more people who need context. And if you want to continue exploring this theme, there's another video right beside this one that expands on the next layer of this discussion.